You've heard it a million times, buy a house, it's the best investment you can make. But what if I told you that cozy little nest egg might actually be more of a money pit? Turns out your dream home could be a financial nightmare waiting to happen. And no, I'm not talking about that creepy doll you found in the attic. Now, I know what you're thinking, but my parents made a fortune on their house. Well, buckle up, Buttercup, because it's time to learn how money works in the wild world of real estate. And trust me, this ride's bumpier than that pothole-filled road leading to your up-and-coming neighborhood. The first dirty little secret? Houses are actually pretty crappy investments compared to other options. I'm talking worse than stocks, worse than bonds, maybe even worse than your cousin's totally legit cryptocurrency scheme. But just how bad are we talking? And what makes stocks so much better? Stick around, because we're about to dive deep into some numbers that'll make your high school math teacher proud. Studies show that over the long run, the stock market has delivered average annual returns of around 10%. Houses? A measly 4 to 8%? Ouch! That's like comparing a Ferrari to a rusty old bicycle with a flat tire. But wait, it gets even more depressing. When you factor in inflation, that 4 to 8% return starts looking more like 1%. Suddenly, your investment is barely keeping pace with the rising cost of avocado toast. But surely there must be some upside to home ownership, right? What about all that equity you're building? Well, funny you should ask. But wait, you cry. What about all that sweet, sweet leverage? Well, about that. Leverage is like financial steroids. It can pump up your gains, but it can also make your losses way more painful. When housing markets tank, which they absolutely do, that mortgage becomes an anchor dragging you down to the depths of financial despair. But just how bad can leverage burn you? Let me paint you a picture. Imagine you buy a $300,000 house with a 20% down payment. That's $60,000 of your hard-earned cash. Now, let's say the market dips just 10%. Suddenly, your $300,000 house is worth $270,000, but you still owe the bank $240,000. That means your $60,000 investment just shrunk to $30,000. Ouch. A 50% loss on your investment from just a 10% drop in home value? Still feeling good about that leverage? And unlike stocks, you can't just click a button to sell your house in a panic. You're stuck with that albatross, watching your investment hemorrhage value faster than a TikTok trend goes out of style. But hey, at least you've got all those fun homeowner responsibilities to distract you, right? Speaking of those responsibilities, let's talk about the hidden costs of home ownership. You know, all those little surprises that pop up faster than weeds in your neglected backyard? We're talking property taxes, insurance, maintenance, repairs, the list goes on and on. But just how much do these sneaky expenses eat into your returns? And are they really that bad compared to renting? Well, buckle up, because we're about to crunch some numbers that'll make you want to hug your landlord. According to the U.S. Census Bureau, the average homeowner spends about 1/4% of their home's value on maintenance and repairs each year. On a $300,000 house, that's $3,000 to $12,000 annually. And that's just for the routine stuff. Got a leaky roof or a furnace on its last legs? Prepare to kiss a chunk of your savings goodbye. But wait, there's more. Property taxes can easily add another 1-2% to your annual costs. And don't forget about homeowners insurance, which typically runs about $1,000 to $3,000 per year. All told, you could be looking at annual costs of 3 to 7% of your home's value just to keep the lights on and the roof from caving in. Now, I hear you saying, but houses always go up in value. Well, allow me to introduce you to our old friend, the housing bubble. These bad boys can inflate faster than your ego after 3 beers, and when they pop, it ain't pretty. Just ask anyone who bought in 2007 how that guaranteed appreciation worked out for them. But surely we've learned our lesson from 2008, right? The housing market must be more stable now, right? Well, that's where things get really interesting. Stick around, because we're about to dive into some current market trends that'll make your head spin faster than a realtor at an open house. Now, let's talk about those housing bubbles. They're like the soap bubbles you blew as a kid. Fun to watch, but inevitably destined to pop and leave you with nothing but sticky hands and disappointment. But how do these bubbles form? And more importantly, how can you spot one before it bursts in your face? Well, one key indicator is when house prices start rising much faster than rents. It's like if the price of cars suddenly skyrocketed but taxi fares stayed the same. Something's gotta give, right? Economists warn that when house prices surge 5 to 6% per year while rents climb only 2 to 3%, we might be entering bubble territory. But here's where it gets really wild. Remember the housing crash of 2008? Well, right before that lovely little economic meltdown, the price-to-rent ratio in the US was about 18% above its long-term average. That's like your normally frugal friend suddenly splurging on a solid gold toilet, a clear sign something's not quite right. And here's a fun fact to keep you up at night. In some markets today, we're seeing price-to-rent ratios that make 2008 look like amateur hour. But surely this time it's different, right? Right? Now let's throw another wrench into the works. Institutional investors. These are the big boys, the corporations and investment firms with pockets deeper than the Mariana Trench. And guess what? They've developed quite the appetite for single-family homes. In some U.S. neighborhoods, these deep-pocketed investors own up to 12% of the local housing stock. 12%. That's like finding out that 1 out of every 8 houses on your block is owned by a faceless corporation. Feeling cozy yet? But why should you care? Well, imagine if these big players suddenly decided to cash out. We're talking about the potential for a massive sell-off that could send local housing markets into a tailspin faster than you can say foreclosure auction. And it gets worse. Some projections suggest that by the end of this decade, institutional investors could own 10 times as many single-family homes as they do now. That's right, we could be looking at corporate landlords owning a whopping 10% of all U.S. family homes. Still feeling confident about that safest houses investment strategy? But wait, there's more. Isn't there always? Let's talk about a little thing called climate change. You know, that pesky global phenomenon that's making beach houses a bit too beach. Turns out, Mother Nature is coming for your property values with all the subtlety of a bull in a china shop. Floods, fires, hurricanes, they're like the 4 horsemen of the real estate apocalypse, minus one horseman who probably got stuck in traffic due to rising sea levels. Insurance companies are starting to run screaming from high-risk areas, leaving homeowners holding the very expensive bag. And we're not just talking about coastal properties or areas prone to wildfires. Climate change is redrawing the map of safe areas faster than you can say, "Where did this tornado come from?" But surely the market has priced in these risks, right? Oh, you sweet summer child. According to recent reports, American homes in many areas are massively overvalued because current prices don't fully account for these rising climate risks. We're talking potentially billions of dollars in overvaluation. It's like buying a car without realizing it has no brakes. Sure, it looks great in the driveway, but just wait until you need to stop. In some regions, insurance premiums are already starting to spike. And when insurance gets too expensive or simply unavailable, well, let's just say your dream beachfront property might turn into more of a nightmare. But here's the real kicker. These climate risks aren't just a problem for coastal McMansions or houses built in Tornado Alley. As weather patterns become more unpredictable, areas once considered safe havens might find themselves in the climatic crosshairs. That quiet Midwestern suburb, it might be one freak storm away from becoming the set of Twister 2 Electric Boogaloo. So, what's a savvy investor to do? Should we all just resign ourselves to a lifetime of renting? Or is there a way to navigate this minefield of market bubbles, corporate buyers, and angry Mother Nature? Stay tuned, because we're about to dive into some strategies that might just save your financial bacon. Now, I know what you're thinking. Okay, smart guy, if houses are such terrible investments, what should I do instead? Live in a cardboard box? Well, unless you're really into that minimalist lifestyle, probably not. But don't worry, I've got some ideas that might just blow your mind and hopefully not your savings account. First up, let's talk about renting. I know, your grandpa probably told you that renting is just throwing money away. But is it really? Let's crunch some numbers. Remember all those sneaky costs of home ownership we talked about earlier? Property taxes, insurance, maintenance, the whole shebang? Well, when you rent, that's all your landlord's problem. Suddenly, your housing costs become a lot more predictable. No more surprise $10,000 roof replacements or middle-of-the-night plumbing emergencies. Just a fixed monthly payment and maybe the occasional strongly worded email about that leaky faucet. But here's where it gets really interesting. What if instead of pouring all your money into a down payment and mortgage, you invested the difference? We're talking about taking that extra cash you're not spending on home ownership and putting it into a diversified portfolio of stocks and bonds. Now, remember those return rates we talked about earlier? While your homeowning friends are crossing their fingers for 4.8% annual appreciation, you could be riding the stock market's historical average of 10%. And the best part? No lawn to mow on weekends. But what if you still want exposure to the real estate market without all the headaches of home ownership? Well, have I got a treat for you. Let me introduce you to your new best friend, REITs. REIT stands for Real Estate Investment Trust. Think of it like buying stocks, but instead of owning a piece of a company, you're owning a piece of a bunch of properties. Office buildings, apartments, shopping malls, you name it, there's probably a REIT for it. The best part? REITs are required by law to pay out 90% of their taxable income as dividends to shareholders. That means you get a steady stream of income without ever having to unclog a toilet or argue with a neighbor about their overgrown hedge. And here's a fun fact for you. Over the past 20 years, REITs have actually outperformed the S&P 500. That's right, you could have made more money investing in REITs than if you just bought an index fund tracking the broader stock market. Not too shabby, huh? But wait, there's more. I feel like an infomercial host, but I promise I'm not trying to sell you a set of steak knives. Let's talk about something called geographic arbitrage. Fancy term, simple concept, live where it's cheap, earn where it pays well. With remote work becoming more common, this strategy is more viable than ever. Imagine earning a Silicon Valley salary while living in a low-cost area. Suddenly, that overpriced shoebox in San Francisco doesn't look so appealing, does it? Now, I'm not saying you should pack up and move to the middle of nowhere, but maybe that charming small city a couple hours away from the big metro area starts looking pretty good when you realize your housing costs could be cut in half. But what if you're dead set on owning property? Well, there's still hope for you, you stubborn mule. Just kidding, I respect your life choices, sort of. Anyway, if you're going to buy, at least be smart about it. First off, think long term. The longer you stay in a home, the more likely you are to come out ahead financially. Those transaction costs we talked about earlier, they become a lot less significant when spread out over 10 or 20 years instead of 5. Secondly, be realistic about your expectations. Your home is not an ATM. It's not going to magically double in value every few years. Treat it as a place to live first, and any appreciation is just gravy. And finally, consider house hacking. No, this doesn't involve a computer and a ski mask. It's about finding ways to offset your housing costs. Maybe that means buying a duplex and renting out half, or getting a place with an extra bedroom you can Airbnb. Get creative. Now, I know we've covered a lot of ground here. Your head's probably spinning faster than a real estate agent's sign in a windstorm, but here's the bottom line. Houses aren't inherently bad. They're just not the foolproof investment they're often made out to be. So, what's the takeaway from all this? Well, maybe it's time to rethink that white picket fence fantasy. Maybe your path to financial freedom doesn't involve a 30-year mortgage and weekends spent at Home Depot. Maybe, just maybe, there's a smarter way to build wealth without tying yourself to a giant immovable asset. But hey, don't take my word for it. Do your own research, run the numbers, and most importantly, think critically about the financial advice you've been fed all your life. Because at the end of the day, the best investment you can make is in your own financial education. So, what do you think? Are you ready to ditch the homeownership dream and join the REIT revolution? Or are you still clinging to that "my home is my castle" mentality? Drop a comment below and let us know your thoughts. And if you've got any house horror stories of your own, share those too. Misery loves company after all. And hey, if you found this video helpful, or at least entertainingly depressing, don't forget to like, subscribe, and hit that notification bell. We've got plenty more financial myth busting coming your way. Until next time, keep learning how money really works, and maybe think twice before signing that mortgage paperwork.